Hi, everyone. I'm Vic Gatto. This is Harnessing the Storm. Thanks for logging in. Super excited about today's show. We have Jim Corman, head of the AIM group on. I've known Jim for a long time. He's a great guest. AIM is one of the largest angel groups in the country. They are the largest in the Southeast with 8 chapters, over 250 members. Jim has been an entrepreneur. He has built and sold 4 different companies, the largest one being up to 2,000 employees. He's been doing angel investing since the 80s. So he's done hundreds of investments. He's been investing since Reagan was president. He's a professor of entrepreneurship at Auburn University, knows entrepreneurship, knows investing, knows building companies, super good guy. He founded the AIM group 7 years ago because he wanted to bring in other people to the community, teach them how to do angel investing. And now AIM is one of the largest groups on the planet. So we dig into a lot of stuff in this show. It's really exciting. Please listen to it. We will, at the first, we'll talk about healthcare, the U.S. economy, the public stock markets, how healthcare is going to affect that. We debate that back and forth. And then we really both agree on the fact that it is a huge opportunity for individuals with an appropriate net worth to dive into angel investing, private investing, venture investing. Huge opportunity. But as you know, I've talked about it before. Jim will say it again in this meeting. There are lots of risks to think about. You need to diversify risk. There's illiquidity. There's a lot of failure. How do you avoid that? What's the appropriate way? What are tools to approach that? And then we talk about the different strategies. So AIM has one approach, Jumpstart has another one. There's lots of platforms out there to help individuals be successful in angel investing. We talk through the pros and cons of that so that you can understand how to think about it for your own accounts. So I have Jim Corman here today. Welcome, Jim. Thanks for doing this.
Oh, you're very welcome.
I'm excited to hear what's going on with the AIM group and your background and what you think of angel investing. As you know, I'm putting together a group of thought leaders really about different aspects, healthcare, private investing, lots of different threads I'm kind of weave together into kind of an overarching thought of where the private investing market is headed in the next couple of years.
All right.
To start with, you've done a lot of things. You were an entrepreneur, CEO, built several companies in the telecommunications space, invested for a long time, angel investing personally. I know you're a professor. Then you've now jumped back in and leading a fund, an angel group and a fund. Give us a quick summary of your background.
Well, I am a serial entrepreneur. Blessed and fortunate, I guess, over that 45-year period to have had 4 companies that ultimately grew up and were either sold or merged into larger publicly traded companies. And after I had sold my last company and had worked through a transitional contract with the publicly traded company, was recruited to Auburn to teach entrepreneurship. So Jane and I moved to Auburn and was teaching and was doing angel investing. I started my angel investing career back in the early 80s, right after Jane and I had our first successful exit. I convinced her to let me take a portion of the proceeds and
little bit of fun money. Let me play with this and have fun with it. Right?
Yeah, I called it my play money, and Jane did not like that answer, that term. So, but started, and so from the 80s up until about 2011, was an individual angel investor. Invested in 47 companies that weren't my own, and so had moved to Auburn. Was doing the angel investing, was doing the teaching. Then got exposure to the concept of an angel network. And so with the help of my son, Clay, we organized a small group here in the Auburn, Opelika area in 2011 and decided about 6 or 8 months into that we wanted to scale. And so we, almost exactly 7 years ago this month, created the Angel Investor Management Group, the AIM group. Mm-hmm. And it's designed to be a multi-chaptered network where we go to several different cities, organize groups of angels in those cities, but have everybody become a member of AIM. So it becomes an umbrella organization,
right?
And allowed us to get scope that way. So we've got angel groups in Nashville, Huntsville, Birmingham, Montgomery, Auburn, Mobile, Dothan, Pensacola, and as of March the 6th, Atlanta.
Oh, wow. Okay.
And so we've completed 61 transactions in those 7 years, invested about $42 million in tech-enabled early-stage companies, all but one located here in the Southeast.
Great. And I think the largest in the Southeast and one of the largest across the country. Is that right?
Yeah, I think we have maybe 250, 260 active dues-paying members. So by membership and by dollars invested, we're the largest in the Southeast and probably 6th or 7th largest nationwide, something like that.
Great. Well, so I came to the right place as far as how to approach angel investing, it sounds like.
Well,
I'm interested in your background, particularly in the transition from CEO of a company, and I know a couple of your companies got to decent size with several thousand employees.
Right.
What was that transition like where you are running the show, CEO? Of course, you have a team, but you're running the whole company yourself and have your hands on it every day. What's that transition like to investing? And there's another CEO and another team. Just like emotionally, did you build systems for that? What was that transition like from CEO to investor?
Well, I think that probably one of the 2 or 3 biggest transitions that I've noticed is that there's a whole lot less stress.
Yeah.
Being the CEO of a very fast-growing company or companies, and on the cutting edge of technology, and being small with larger competitors all around, that's just it's a very high stress type position. And as an angel investor, and even as a professor, I'm not responsible for 2,000 people.
Right.
I'm responsible to manage one. Now, as AIM has grown, we now have 8 or 9 employees, 5 full-time and 4 part-time. But still, the level of stress associated with running an organization of 9 versus 2,000, or having 250 angels to keep happy versus 2.1 million customers.
Right.
Just a lot less stress, but as well, I was used to, as a CEO, whenever I said something, it got done.
Right.
As an investor or even a board member, I've learned that I no longer issue orders. I offer suggestions.
Right. Maybe you have influence if it's a good suggestion. I think that's probably the reason I asked. Is I was a CEO in the 90s myself at a startup, not your size, but a similar growth, success. We had a good exit. And then I transitioned over to the venture side, and I found it a challenge. Yes, there's less stress, but I liked having my hands on the wheel and being in control of things. Maybe I'm just kind of a type A personality, but it took me probably 2 years to get used to the idea that I could maybe hire and fire the CEO. I could make suggestions. I could offer guidance. But at the end of the day, that CEO had to actually do the work, and I wasn't allowed to. I had to sort of be in the back seat or be on the sidelines. And I understood that intellectually, but it took me a while to kind of, live that out. So.
Another transition that kind of helped was that I was an athlete growing up, loved to play sports, and then later on, particularly I have 2 daughters and a son, all 3 of which played athletics, and I coached all 3 at different levels, and so to a large extent, I'm much more of a coach now than the player.
Yeah, I want to talk through a bold prediction that I've been talking about. Part of the reason I started this show was to really get smart people from around the country to chime in and weigh in and tell me where it's wrong, where it needs assistance, where it needs to be improved. And every Christmas, I take a few days off and really try to figure out where is my career going, where's my business going. I run, as you know, I run Jumpstart, which is an investment platform. Where are we going to invest next year, in the next several years? I send my boys skiing, and I'm in the lodge really just thinking and writing. And this year, I kind of scared myself a little bit, and it made me think I should put it out there and get other people to comment on what I see, and maybe it is right but needs to be shifted by 10%. Maybe it's totally wrong. But what I see out there is, and what I want to dig into for the next few minutes is healthcare, I think, is going to change pretty dramatically in the next 5 years, the next 3 to 7 years. I think that's going to have a really hard impact on the stock market and on employment, and be a drag on public markets and the economy, GDP, over time. And then simultaneously, the boomers are all pulling money out. And so my prediction is that the stock market actually peaked in 2018 in that sort of October, November timeframe, and that the next 10 years are going to be a really difficult path for the public stock market and for the economy overall. I want to dig into all of those threads over the next little while on the show. But do you have initial impressions, or what's your just gut level response to that?
I think you're wrong.
Okay, good. Well, let's dig into the details of that. Are they wrong on every count, or in only certain ones?
Well, I definitely think that healthcare, there's lots going on, and it's truly being disrupted. I agree with that. In terms of there being massive job loss and being a huge drag on the economy, that's where I disagree. And in terms of the overall market, I think 2019 may prove you wrong, that it didn't peak in 2018.
Yeah.
But I don't disagree with, look, I've been through the oil crisis of .74,
yeah,
Black Monday and Black Tuesday in the
right.
80s, the dot-com bust in 2000, the financial system collapse in 2007 and 8. I mean,
right.
Look, I've seen the market take a lot of hits, and I just don't see anything major. I mean, I fully expect to see some correction, but I think we'll see a correction, and the market will do what it's been doing for 50 or 60 years. If you look at it over a reasonably long period of time, you're going to see a 8 to 10, maybe even 11% compounded growth.
Yeah. Okay. Well, so let's dig into that in
right.
detail. I mean, I think we can be pretty quick about the healthcare industry. It sounds like we agree on that front. So, over the next several years, 5 years, let's say, it sounds like you agree the healthcare industry is going to be disrupted. I see sort of 4 trends. I think care is moving outside of the acute care hospital and into communities, suburbs, and in the home. Sort of a broad trend. More and more services are being done outside of the hospital. I think consumers are taking control of their own healthcare. We're talking about the rise of the consumer in healthcare, where more direct to consumer, more brand, they need more information, more transparency, they have to pay more. And I think there's technology tools, artificial intelligence, big data sets, a thing called FHIR that's allowing interoperability. HHS just came up with a rule sort of demanding that hospitals allow data to flow between centers so you don't have data silos. All those things I think are going to be really empowering for innovators to deliver better care to patients.
Right.
And I think that's going to be wonderful for me as a patient, but I think it's going to really and this is where maybe we disagree. I think large publicly traded health systems are going to have a hard time innovating quickly enough. And there's going to be more startups and high growth companies, venture backed, maybe angel backed through AIM, or private equity backed, that will grab a lot of that new aspect of the business. And so that's where I think we differ, is that there will be solutions in the marketplace. I think they're going to be backed by places like AIM or MyVC, Jumpstart, or bigger private equity firms, and not so much go public immediately in the public markets. I think you get a lot of stuff in the private side.
No. I mean, Vic, I think we really agree there. Let me explain. What I tell my students, what I tell entrepreneurs, look, you want, if you're an entrepreneur, you want things to be changing. And the fact that you have regulations changing, the fact that you have technology advancing at a rapid growth within healthcare, and then you throw in the growth of healthcare, and particularly chronic care associated with the aging population here in the United States, when all of that really benefits early stage companies. You know, if you're an existing large company, you can't turn on a dime, and a small company can. You already have millions of dollars invested in training and equipment in these older technologies. I mean, I think the larger established healthcare companies are really going to struggle. I think there are huge opportunities for the entrepreneur for all of those reasons. And I think that ultimately what you're going to see is that the larger established healthcare organizations are going to have to innovate through acquisition.
Right.
They can't keep up internally with the rate of change within technology, and there's just too much going on. But they still have access to capital. They have access to very sharp people and lots of facilities that I do think that their models are going to be disrupted. And I think for them to survive, and certainly for them to prosper, they're going to have to be more innovative, and large organizations can't do that internally. They're going to have to do it externally.
Yeah, I think the difference between, in my view, this is what I wanted to start talking about, is that, you know, the automotive industry certainly went through a pretty massive change in the 80s. And the fintech world went through a change, and retail's gone through a change. Big industries have gone through, the steel business is not what it used to be. Significant innovation, new technology has come to these industries. And as you say correctly, the American economy bounces back, and it finds new ways to innovate and prosper. And I think the difference in my mind this time around is two things. The large health platforms, so there's several, I don't want to name them because I'll get in trouble here in Nashville, but the large publicly traded hospital systems, the large insurance systems, I don't think they can innovate successfully. And I think the Google, Apple, Amazon, Walmart, Salesforce have all announced in the last 6 months that they're coming into healthcare fairly aggressively. And so the question is not will entrepreneurs and innovators create new great things. I think they certainly will. They have in other industries, they will in this industry. You and I will invest in them and do well as they grow up. The question is who will acquire those companies, and will it be sort of private equity backed? I mean, take Uber, right? They are multi-billion dollars now, still private. They will go public probably this year sometime. But a lot of that value that in the 80s and 90s, people went public at $100 million, $200 million market cap, and then a lot of the growth was still there. I think nowadays, the private equity folks are keeping that on the sidelines longer. You and I, our portfolios sometimes are selling to private equity-backed companies, not publicly backed companies. So that's where I think the public market may not get the growth that it's had in the past, say, 40 years.
Well, yeah, and so, but I'm looking at the healthcare industry, just not the publicly traded industries overall. I still see lots and lots of opportunity. I still see lots of growth. though I think it is going to be, with all of the changes from a regulatory standpoint, with all of the change in empowering the patient now, with all of those things combined, it's going to be crazy. But at the end of the day, I still think we're going to be innovating. We're going to become more productive. We're going to be providing better care. I think there's value that's going to be created. Yes, some of the larger publicly traded healthcare companies that don't adapt and don't change quickly could take a hit or two across the bow or more. But overall, I still, at least from our standpoint, Vic, we look at we're industry agnostic in our approach at AIM,
right.
But we very much like healthcare, whether it's devices or IT or whatever. We're very positive.
You like it for private investing? Is that what you mean?
Yeah.
Yeah. Is there a public stock that you would say is a good buy? I can't read. You don't need to quote one, but is there one? I can't think of one publicly traded stock that I think I'd buy.
No, I don't have one.
Right, and so
not in healthcare.
That whether it is going to be really a bad storm or just a slight problem, the fact that there is no long play in healthcare, I think is a challenge, right? And the other piece that got me worried over Christmas is 40 million Americans work in healthcare. Right. And, so it's one out of six or seven Americans work in the healthcare sector. And a lot are, of course there's doctors, but there's hospital administrators and nurses and med techs. And a lot of those people are not going to have the same kind of job over time. And so over the next 5 years, as we automate more things and we get better wellness, better prevention, earlier diagnostics, all of which are great things for me as a patient, right. There's less utilization, there's less people in the healthcare system that are going to drive, I think, significant displacement of workers. And these are good middle-class jobs that I think are going to be a challenge to replace.
Well, again, I don't. I agree. I think that we're going to see increased productivity. We're going to see improvements in healthcare, and hopefully we're healthier and as we look at it, have a less and less of a need for it. But still, the starting point is to where we are today. We're already critically short with nurses. We're critically short with doctors. There are a whole number of areas where we need a whole lot more. Now, granted, in some of the existing models, and particularly in the administrative areas that are going to be really impacted by increases in productivity, there's going to be displacement. But I think if you look at overall employment, I think that overall employment is still going to be increasing just because we're already starting off at a point today to where we already have critical shortages and we have a good bit of built up demand. But there are going to be, all the jobs that are going to be created are a lot of people are going to have to be retrained and will have to change.
Right. Yeah, and Jim, I want to talk about the next thing, which is the demographic shift in the country. So part of the thesis is that the baby boomers are aging and they are getting sicker. They're costing the healthcare industry a lot more time and money and utilization. And my thesis is they're going to start selling out of the public markets in retirement. And the question is, will the millennials be able to offset that and invest capital in, or will we have a funds flow issue as the boomers retire? What are your thoughts about that?
Well, I'm a baby boomer. I'm about to turn 66.
Yeah. Are you still investing into growth exchange traded funds?
Yeah, and Vic, I told my wealth managers that if they invested in a a fixed income debt instrument, I'd get a baseball bat after them.
Yeah. Okay.
I am still today. I'm 80% equities, some short-term debt, but and cash. So but I do think that you're right that as baby boomers age, the tendency and historically has been to move away from, or at least de-emphasize equities and emphasize debt. Now, part of the issue is that we're living longer, and we also people are understanding that equities are a hedge against inflation, and I don't think we're going to see the shift to the baby boomers getting out of equities and moving into debt instruments at the level that maybe it's been happening historically. I think there's another trend, and that's the fact that there's going to be a substantial transfer of wealth that's already underway as baby boomers are passing away, and you've got younger generations that now have longer investment horizons. So it's not that money that the baby boomers have is just going to stay in a baby boomer and is going to gradually migrate away from equities because they're aging. I think they're going to hold on to equities longer. I think that as they transfer wealth to younger generations, those monies are going to be in equities. So that I don't see the level of capital leaving equities that maybe you.
Yeah. I mean, they're going to last longer in equities, and then they might move to bonds, but then also there'll be inheritance that goes to the millennials, basically, and then they'll have a much longer time horizon. So they'll be back in, a long, only a lot of equity position.
Yeah.
Okay. So even though we disagree on several things, you have started an angel investing group. My belief is that a very good place to invest is in private markets right now. I think you share that because you're investing a lot of time and your own capital in private markets. Talk about that opportunity, investing in an entrepreneur as they're sort of just getting something going. And what is that like? How do you see that as an asset allocation in the asset allocation mix?
For what age group?
For, let's say the boomers. Let's say, maybe boomers and the next level down. Kind of. I'm 48, so 45 to 70. Say.
Well, traditionally, alternative investments, which private equity would fall into that category. Historically, wealth managers would tell you that 5% of your portfolio max, maybe 10. I would say at this point that if you follow a couple of rules, I would be more aggressive than that.
So you think you already said earlier that the 60-40 equity bond kind of classic portfolio is out the window, right? I mean, you don't have bonds, any significant bonds in your portfolio, the public market, and you'd like to allocate more to private markets. So what are your thoughts? What are you recommending to people in AIM or people you talk to?
Well, I think that look, let's don't underestimate or hide the level of risk that you're exposed to and the illiquidity that you're exposed to in private equity investing, right? And so given that we acknowledge that those are there and we need to address those, I think that number one, if somebody's the amount of wealth that you have, the wealthier you are, the bigger the percentage that you can allocate. You can assume more risk. You're not risking your lifestyle, that sort of thing. I think as well, I think that if you start increasing the allocation to private equity, you absolutely have to be committed to diversification.
Yeah.
I think that.
So let me unpack that a little bit. So there's
Okay.
two aspects to that. The size of your net worth can impact the percentage that you allocate to private investing, private equity, venture capital, angel. Talk about that. Is that because of the illiquidity of it? Is that what you mean? Or give me an example, or how do you think about that?
Their ability to absorb risk.
Okay.
The wealthier you are, the more you can assume a little more risk.
So say there's three families, one guy with a $5 million net worth, another one 15, and another one at 50. How do they look at risk? Or how should they look at risk?
I think the larger the portfolio, the more aggressive that you can become. You can afford to have a larger portion of your portfolio be illiquid. You don't need to have that much cash available to you immediately, and you're not putting your lifestyle in jeopardy. So typically, the larger your net worth, the more you ought to be allocating to private equity.
A lot of people that I talk to, once they have paid for their own retirement, their own needs forever, and then they're paid for their kids, for their estates and things, and they're sort of investing for their grandkids or their legacy. Right. That's where they begin to get more willing to take risks. But I think it's a timeline thing where they have 30 years, 50 years, and so the illiquidity is not as big a deal, and the risk seems less risky if you have plenty of time to wait for these things to mature. Is that what you mean? Is that close to it?
I do.
Okay, and then talk to me about the other thread you mentioned was diversification, which I agree is critically important. And my guess is it's one of the values of being in a group like AIM, because deal flow is really a challenge, right? Like if you are an individual investor trying to make angel investing or venture investments, it's a challenge to see enough deals and put enough money to work. So what is an appropriate level of diversification? How many investments should they be in? And then how can a group like AIM help?
I would say in terms of the absolute minimum number, you need to have at least 12 to 15 positions. Mm-hmm. I think that for two reasons. Number one, Vic, there's the reduction in risk, and you've got such a high level of risk on any one individual investment in these early stage companies that mandates it. But the other thing is that to get the kind of really nice return that we all want, you've got to hit a home run. And the more diversification you have, the more opportunities that you have that you've invested in one or more home runs in that portfolio. So that I absolutely believe that diversification not only reduces risk in early stage private equity investing, but it also helps you on the upside and gives you a much higher chance of having a very attractive overall rate of return.
Yeah. Yeah, I think we agree with that completely. I mean, I think that 12 is probably the minimum that I tell people. I mean, I think I'd like to see you invest in 15 to 20 to 30 over a period of years. But then that is counterbalanced with you got to be in good deals, right? I don't really want you just spraying money around with someone you met at a restaurant, someone you play golf with. These have to be well-researched, fully due diligenced, good opportunities that you spend time on, or people you trust spend time on. And that's where a group like AIM can help share that work around, I think.
Well, I mean, for the last 3 or 4 years, we've processed in terms of companies applying for funding from AIM, we'll get between 500 and 600 applications a year. Mm-hmm. And we make 9 investments.
Right.
So and we never take an investment opportunity to our membership that has not only gone through a screening process, but has successfully completed our due diligence process as well. So that but still, that means that even as we're taking 500 a year down to 9, we're still bringing 9 vetted opportunities to our members a year. We finished, we're at 61 transactions in 7 years. So that's almost exactly 9 a year. And the other way that you can get diversification is by investing into a fund that's going to have a minimum of at least 12 to 15 positions.
Right. Yeah. So as you know, I mean, I think the interesting thing about the AIM model is that in your network of people, there's someone that's a real expert at fintech or manufacturing or healthcare or biotech or banking, whatever you're looking at, and you can pull in the expertise. And then everyone benefits from that. As you know, the Jumpstart, our model is to really only focus on health and wellness, healthcare services, healthcare IT, and kind of dive deeply into that, so we can really get strong at that and build connections, and we understand what the industry is doing. And so I think it's important to, through some strategy, get access to investments that are likely to work. And then even with that, there's going to be a lot of failure. Right? There's going to be just little companies, things happen that are unexpected. There aren't that many employees. So if one has a heart attack, all of a sudden now the company is very different than it was before. You lose, if there are 4 customers at this company and you lose one, 25% of the customers are gone now. So there's more risk with these small companies, which means that you have to almost do more due diligence and be experts at it.
Oh, I agree. I think that that the level of expertise and the amount of sheer manpower that you can apply to healthcare through Jumpstart allows you to effectively invest in an earlier stage company that we couldn't touch. Yeah. I mean, you've got access to a knowledge. You can nurture those companies. You've got access to networks of personnel. You've got relationships with the companies in healthcare.
And usually we'll be investing super early, but we know, this person at a hospital is going to be a pilot customer before we invest. So I'm going to bring them there. So I'm bringing money, but also a customer with me. And it's just I'm sort of mitigating my own risk a little bit.
Yeah.
But then I miss out on a new fintech thing that y'all would be doing. So it's choices. It's sort of pluses and minuses.
Yeah, I agree.
So I want to come back to the investment allocation. I've been talking about allocating 25% of your net worth. If you have your expenses, your retirement, your expenses, and your kids taken care of, and you now are sort of building for your estate and your grandchildren, 25% by allocating 5% a year over the next 5 years. So you get time diversification and deal diversification. Does that make sense to you? How do you think? I know it changes based on your net worth, but how do you think about the percentages?
Again, I think as long as you're committed to building a diversified portfolio, as long as you're avoiding that spray and pray model where you're just investing in the cocktail party, suggestion, right, and you're having well thought out, well vetted ideas. I think that works. I do think that what I would tell somebody if they were contemplating or they were going to be implementing where they were going to have 25% of their money in private equity, what I would tell them is that you probably ought to have a higher percentage in short-term bonds or cash. Mm-hmm. So that one of the things that I would say is that you are going to have cycles like you do in any market, but you're going to have cycles in private equity. And number one, you need to maintain, you need to offset that illiquidity that you have with private equity with increased liquidity in terms of cash or short-term debt on the other end. But the other thing is to make sure that you have opportunities that when we do have downturns in the private equity market, that you're not leaving the market. Yeah, you're not going to have your exits are not going to be as good. You're not going to be getting as much money. But when you put that money back to work, or you're making new investments, you're investing at much lower valuations than you used to as well.
Yeah, the buying power is much better on those downturns. Yeah.
So you've got to have that buying power. And
Right.
to have that buying power, you need to have had cash, a fairly risk-free cash sitting in reserve to take advantage of that.
Right.
So that
I completely agree. So it's almost like a barbell approach, right? Like you put more money in the private equity, it's illiquid, it delivers a better internal rate of return, better return profile, but it's volatile. And so to offset that, you have a bond portfolio that's 2 or 3 years of your cash needs, and also liquidity for follow-on investments in the really good ones. And in a downturn, you can pile in when the buying is good.
Exactly. I think, and the other thing, just from a global standpoint, Vic, is the fact that we really don't have that many companies going public. And so the publicly traded equities market is not expanding that much.
Right.
And you have so much more wealth being handled by private equity and venture capital and angel now, the private equity markets. I really think that you need to be shifting more, because the supply of companies, the number of companies available in the private equity world in relative terms to the publicly traded equity world, there's
better. There's more opportunity there. Yeah. And there's less opportunity in the public markets. There are institutions, take 401ks, for instance, some big institutional buyers that could only buy public equities. And so they're having to buy in a fewer and fewer set, which I think drives up the multiples.
Right. And so, but I don't mind those multiples, because those might be the companies that are.
Yeah, it helps the exits. It helps the exits.
We love for them to have an attractive currency.
Right. Good. Well, quickly, we're going to take just a short break. Jim, talk about the AIM model. How does it work in practice? What are the logistics? What does it look like to a member to join AIM?
You pay annual dues.
Okay.
You become the decision maker. We're going to bring you 8 or 9 vetted deals a year. You decide if you want to invest, and if you do, how much. We do have a minimum investment of $5,000 per investment, but it's pretty much an individual decision maker model. But we will bring you a wide variety of industries and technologies. But that's pretty much the way that.
And I've been to one, so I know. But you have a meeting once every couple of months where people come and meet the entrepreneur and hear the pitch, right. And then they decide after that. Right.
That's right. We will have a meeting at every chapter. Every company will be presenting to every chapter. The company presents, then there's Q&A. We excuse the executives from the room. Then we give a due diligence report, what we've learned in the due diligence that we've completed. And then they can ask, the members in the audience can ask questions of us. And so it's an hour and 15 minutes. Highly structured. We're very sensitive to the time. And then what we do is that at the end of every roadshow, we have a kind of a studio quality produced video of the company's presentation of our due diligence report. We give our written due diligence report and the term sheet. All of that gets distributed to every member, whether they attended a meeting or not. And so,
so if I missed it, you can still review that and see the video and make your decision.
That's right. And we give everyone 2 weeks after the end of the roadshow to give us their final answer in terms of whether they want to invest, and if so, how much. Then we create a unique LLC for that investment, and you've got and we send you a subscription doc off of that newly created LLC, and you've got 2 weeks to execute the subscription docs and get us the check or the wire transfer. We do that electronically through DocuSign.
Okay, and so everyone I would call it self-directed, that they are coming to the meetings and deciding to be in or not in, and the amount.
That's right.
And so that's contrast that against what Jumpstart does. We manage a fund that does 15 to 20 health-only investments every year.
Right.
It is not self-directed. We are picking the companies. We're doing research on the industry. You look at 600 or 700. We look at 3,500 or so a year, but only in healthcare, and really dive into those. It's largely automated, and then humans look at the last 150, 200. And then you can co-invest, and you can pile in and put more capital amongst of the 20. Maybe you like one or two, you can put more capital in those, but you're automatically spread across the whole portfolio for that year. And then we manage it for you, and there's results. And so it is much more passive. You can learn about it and invest, but we are managing it for you. If you want to come in and double down and put a little money in, you're allowed to. And so it's just contrasting. And as people learn about this space, I think that's important to note that there's lots of different ways to approach this. I'm not sure anyone is necessarily right. There just are differences that might be right for one investor and not for another. And so AIM is self-directed and diverse across all industries, whereas Jumpstart is more professionally managed and only healthcare. And you could put a little money in both, but there probably are pluses and minuses of the two different models.
And we recognize that, and so AIM now has a fund.
Oh yeah, right. Yeah, so you just launched a fund recently, right? Yeah.
Yes.
Okay.
And it works very similarly, like just what you talked about. And Vic, the reason that we did that is for several reasons. But number one, to participate in our network, you realistically pretty much have to be in a city where we have a chapter.
Right.
By having the fund, you can be located most anywhere.
Right.
The other thing that we found is that there were a lot of people, even when they were in cities where we had chapters, they would come up to me and they would say, Jim, I just don't have the time to come to the meetings,
right.
the materials. Time's my most precious commodity and I just don't have it. Or somebody might come up and say, look, Jim, I'm trained as a vet. I'm trained as a pharmacist. I can't come to a meeting in an hour and 15 minutes, look at an early stage high-tech company and determine whether I ought to be investing in it or not.
Right. I trust you to do that.
They don't have the training or the acumen. And so the fund gives you that ability to participate in the asset class without having to have the background or the training or to have the time to participate in an angel network.
Right. Yeah, I think it's a good option for people that don't have the time and want to be sort of allocated across all the assets. I mean, I find at Jumpstart, we are deep into the regulatory changes. I mean, HHS just came out with new policy last week. I had people crawling all over it Thursday, Friday, over the weekend. And a normal human who's working in their day-to-day life can't spend that time and really focus on it. And it's our job to do that. So they can come in and play, and maybe they find one of the 20 companies that they really like and they could help the CEO, they put a little more money in. But the job is to manage the entire portfolio and make them money and sort of diversify their risk and find that home run in there, and then find the next 8 that are going to be reasonably successful and make sure they're allocated across those. And AIM does the same thing now. You have both sides of it. Talk about the SEC accreditation rules, just so people understand out there that are watching.
Well, there's essentially 2 tests, and you have to meet one or the other. One is a net worth test. You have to be worth more than $1 million, and that cannot include the equity in your primary residence.
Right.
Now, if you don't meet the net worth test, you can meet the income test, and that's over the last 2 years, filing as a single taxpayer. If you had income of $200,000 a year in each of the last 2 tax years, then you qualify. If you file jointly, if you had collectively with your spouse $300,000 worth of income the last 2 years, you qualify. So you don't have to meet both. You just have to meet one. You either have to meet the net worth or the income test.
Right. And at least at Jumpstart, I think at AIM, because we've known each other for a while, I don't want people to be that close. Like if you are having to go measure your income carefully or look at your net worth, this might not be the best place for you. Like I think the rules are in place for good reasons, and we want to help people that are, you need to be significantly over the hurdle. So you can be at 1.5 or 2 or 5, or your income is significant. I don't want people to be sort of so close to the line that they're sort of checking their net worth every meeting or every fund to see if they qualify or not.
Well, or I would say that the closer they are, the smaller percentage of their portfolio they need to be putting in.
Yeah, that's probably a better way. If you sneak over it, you need to stay at that 5%, maybe even 2%.
Yeah.
Just and learn. Maybe it's valuable to learn a little bit, but do it with a small amount of capital.
And frankly, Vic, that's where we came up with the $5,000 minimum. Mm-hmm. Is that if you take 5% of $1 million investment portfolio, that's 50,000. With AIM, you can still get a portfolio of 10 positions,
right?
5,000 each.
Yeah. Right.
And that's really how we kind of came up with the minimum investment is frankly to accommodate those people who are just right over the 1 million mark.
Yeah. Okay. Great. Now, talk about AngelList or some of the online platforms that allow you to quickly spray money around into different angel investments. Have you done that at all, or do you know much about those platforms?
I do. I haven't done a whole lot. I've done most of my investing through AIM. But we're very familiar with AngelList. I think part of it is that AngelList and those organizations themselves don't do a great deal of due diligence. Mm-hmm. And so you're probably putting more of a burden on the investor to perform that due diligence than they would if they were participating in an angel network or a fund. Now, a lot of cases you can have a syndicator that has already performed some due diligence. Now, they don't give you access to all of that due diligence, but I think if you had one of those syndicators that you trusted and you felt like that, and knew they were making the investment, that might help be somewhat of a guide. But generally, you're tending to invest a little bit more blindly in those platforms than you would if you were in a
so that fits with the way I think about it. I don't think an index fund of early stage investments, private investments, makes sense. I think most early stage investments fail, and the really promising, really exciting ones get oversubscribed. You and I both are often seeing a company that's really exciting. We have to kind of elbow our way in and get a position for our investors or for our fund. And those are not the deals that are easily to get into on AngelList or any of these platforms. And so I worry that kind of taking an index approach, I'm going to put a little bit in 100 companies on one of these platforms. It's very easy to do that, but I think you end up getting sort of the average performance, which is pretty bad. And even the best deals are not in that average. They get sort of pulled out.
Right. I mean, we've done from an industry perspective, I know of 3 sort of industry surveys that have been done over probably about a 20-year period of time. And almost all of those will tell you that at least 30 to 33%, and usually closer to 50% of angels investments end up crashing and burning, where you lose all or substantially all of your investment. And part of with AIM, I mean, we've invested in 42 companies now, and we've had 4 crash and burns, and we have 2 that we think could be that way. So if we look at our entire portfolio of exited and our current portfolio, out of that total of 41, we're probably at 5 or 6. So we're probably at 15 or 16% when the average across the industry is maybe at 40.
Right.
So,
yeah, I mean, I think in Jumpstart's the same. We have 62 investments, and I think there are 7 that are either dead or I call them zombie companies. They haven't died, but they're about to die sometime. They're just going to keep stumbling along. But this is hard work. I mean, you need to dig through a lot of pretenders, really focus on the due diligence, focus on the technology, the market, the financials, the team. And that's hard to do over the internet virtually. It's more of a face-to-face, look the team in the eye and really dig into it. And that means that you need some platform like AIM or like Jumpstart, or there are other platforms that are good, where they're doing that real kind of roll up your sleeves and get into the work.
Sure. I mean, if we're not delivering that kind of value, then everybody ought to be investing in an index fund.
Right, right.
Hopefully, hopefully we're not going to have 40% crash and burns, and we're going to have our members or our investors are going to benefit from it. Vic, it's not only the due diligence that's performed, but the involvement with the company's post-investment,
right,
to give them an increased chance of success, and that's at the board level and the consulting and advisor level. There's a lot of value that we can bring to our members by supporting our portfolio companies beyond just writing a check.
Yeah, I mean, we find that now with 62, there'll be a company that's trying to sell to a big buyer in healthcare. And when we look at our portfolio, there'll be 6, 7, 8 other companies that have gone through that courtship process, procurement process, contracting process. And we can sort of easily share information back and forth that really helps the different portfolio companies in a way that you couldn't do if you were just in one.
Yeah, I agree completely.
Okay, any other trends you see out there that we haven't touched on that we should?
None that come to mind.
I have a question about how do you recommend someone who's watching that's interested in getting involved in angel investing or interested in early stage investing? What do you recommend they read or learn about? How do they educate themselves? How did you get involved in it? How do people learn about it? How should they learn about it? Does AIM have educational stuff, or is there something you'd recommend?
Yeah, I think from the AIM perspective, number one, if people are interested, we love for them to come to a meeting, get to see presentations, get to review the materials that we're doing without having to make any kind of commitment. So they do have the opportunity to come. We do have, and because only about 20% of our members have really done any kind of structured private equity investing before they come into AIM. And so we have a new member orientation. We've got seminars that we offer both live and through video. And then the other thing too is that, Vic, I think that with having a relatively low dollar limit, you can stick your toe in the water and you can begin to invest and go through the process and get to see the cadence of the company and review the reports and begin to get a feel in terms of how you want to make decisions and when you're doing this. So that that's the approach that we have.
I mean, for $5,000, you might say, instead of going to that golf weekend in Ireland, Scotland, Ireland, I'm going to do this, and it'll be longer term, more educational. And then if it goes badly, well, I didn't play golf this quarter.
And then the other is that there's some people that say, look, I don't want to become a professional. I don't want to get involved, but I do want access to this asset class. And that's when they need to consider a fund.
Right.
You don't have to go through an extensive learning curve to be an investor in a fund, because you're not going to have to make any kind of investment decisions. The investment committee of the fund will do that for you.
Yeah, and so Jumpstart has a $50,000 minimum for its funds. Do you have a minimum for your funds? Is it the same 5,000 or higher?
No, it's a $200,000 minimum for the fund.
Okay.
And that's over about a 2.5-year period of time, 4 capital calls.
Okay.
So it's $50,000 a capital call.
And that happens over 2 to 3 years. So we said.
That's correct.
Yeah. Okay. Okay. Good.